Let's talk about the bedrock fund. Set it and forget it. The idea is that an algorithm tracks the top companies, and over time, your 401k quietly and automatically builds wealth while you sleep. But that automation has a catch. When you invest in a passive index fund, you give up control. Your account is mechanically forced to buy shares of whatever company gets added to the index. It doesn't check if the company makes a profit, and it certainly doesn't ask if the stock is wildly overpriced. Wall Street insiders understand exactly how this mechanism works. When they have speculative, cash-burning companies they want to get rid of, they know millions of retirement accounts are legally obligated to buy those shares the second they hit the index. In financial terms, your 401k becomes their exit liquidity. You buy the top, allowing early investors to cash out safely. Right now, 3 separate macroeconomic forces are colliding to exploit this vulnerability. Global liquidity is drying up at the source. The stock market has become dangerously concentrated in a handful of tech giants, and the financial exchanges themselves are quietly rewriting the rules to fast-track low-quality companies directly into your portfolio. The very feature that made passive investing easy for everyday people, the automatic, unthinking purchase of stocks, has been turned into a dumping ground. Wall Street is preparing to offload the market's worst assets, and your retirement account is the designated buyer. To understand why the exits are being rigged, we have to start with the global supply of money. For the last 30 years, the cheapest cash on Earth came from Tokyo. The Bank of Japan kept interest rates glued to zero, providing the oxygen that allowed the entire global financial system to expand. This diagram shows the engine behind that expansion, a mechanism known as the yen carry trade. Investors would borrow Japanese yen at essentially 0% interest, convert that cash into US dollars, and funnel it into American assets yielding higher returns. It was essentially free money, and it artificially inflated the prices of everything from real estate to American tech stocks. But earlier this year, the Bank of Japan finally raised interest rates, breaking the assumption that held the entire trade together. When Japanese borrowing costs tick up, the math flips. The pipeline of cheap capital chokes off, and the money that fueled decades of global asset growth is suddenly forced to return home. This reversal triggers an immediate and severe chain reaction. As the yen carry trade unwinds, borrowing becomes expensive everywhere. Financial institutions are forced to sell off assets to cover their higher costs. As that global liquidity shrinks, the underlying valuations of major stocks start to crack under the pressure. Capital flows dictate market health. When the world's most consistent source of cheap cash disappears, the assets whose prices were most artificially inflated by that cash are the first ones left gasping for air. To see which assets are most exposed right now, we can look back at the early 1970s. Following a massive economic boom, investors piled their money into a group of blue-chip companies known as the Nifty 50. These included household names like Coca-Cola, McDonald's, and Polaroid. People believed these businesses were so dominant that they were called one-decision stocks, meaning the only decision to make was to buy them, regardless of the price tag. Polaroid ended up trading at 90 times earnings. But when macroeconomic conditions shifted in 1973 and inflation surged, those completely unrealistic valuations collapsed. Stocks in the Nifty 50 wiped out 60 to 90% of their value, trapping investors for nearly a decade. Today, the market is playing out the exact same scenario. Instead of Polaroid and Xerox, investors have locked on to the Magnificent Seven, companies like Apple, Nvidia, and Microsoft. Once again, people are treating these tech giants as bulletproof investments, bidding their prices up to extreme multiples with a blind optimism that they will simply grow forever.
We can see how top-heavy things have become by looking at this comparative chart. In 1972, the Nifty 50 companies swell to make up nearly 45% of the total market right before the crash. Today, the Magnificent Seven alone account for roughly 36% of the entire S&P 500. Just 7 companies are carrying the weight of the broader stock market. Having an entire index completely reliant on the performance of 7 tech stocks is not a sign of a robust economy. It's a precarious structural imbalance. With the Japanese liquidity tap shutting off, one macroeconomic shock could knock the entire structure over. Wall Street institutions see this tightening liquidity and top-heavy market, and they are preparing their escape routes. To cash out before the music stops, they need to offload massive amounts of speculative risk onto the public. The clearest example of this pipeline in action is Elon Musk's preparation to take SpaceX public.
SpaceX is currently targeting an initial public offering valuation of $1.75 trillion. At that price, it would be worth more than every U.S. defense contractor combined. Yet, when you look under the hood, the consolidated company actually lost nearly $5 billion last year, heavily dragged down by a massive cash-burning artificial intelligence division that had to be rebuilt from the ground up. Under normal circumstances, a company losing $5 billion a year would struggle to justify the largest IPO in human history. To ensure enough guaranteed buyer demand to support that massive price tag, the exchange itself stepped in to alter the mechanics of the market. The Nasdaq recently adopted a new fast entry rule, specifically tailored for these massive listings. They completely removed the requirement that a company needs at least a 10% public float to join the index. They shortened the required waiting period for index inclusion from 3 months down to just 15 trading days, and they quietly added a multiplier that treats a tiny available float as if it were 3 times larger. These highly technical adjustments remove the standard buffers that protect the market. By accelerating index inclusion, Nasdaq legally forces hundreds of billions of dollars in passive ETF capital to automatically buy SpaceX stock within weeks. The risk of holding an unprofitable, wildly overvalued company is seamlessly transferred from insider hedge funds straight into your retirement account. When the unwinding of the yen carry trade fully hits the American financial system, capital will become significantly tighter. Companies won't be able to borrow at near zero rates. Corporate deal flow will stall, and the extreme valuations currently propping up the market will be forced to compress. Because the market is overly concentrated in a few tech giants, and because the rules of the index have been rigged to automatically ingest heavily flawed IPOs, the pain of that compression is pre-assigned. Institutional insiders will have already cashed out, leaving everyday 401k and retirement accounts to absorb the massive losses when prices correct. Most investors will be caught off guard because they are watching the wrong indicators. People spend their time analyzing the Federal Reserve's short-term rate cuts or cheering for the latest artificial intelligence headlines. But those are loud, visible distractions. The actual mechanics dictating the market are buried in the structural plumbing of the bond markets and exchange rulebooks. Treating index funds as an infallible wealth engine relies on the assumption that the system plays fair. But history shows us that blind optimism is the most reliable way to empty a brokerage account. Relying on a passive index as a guaranteed protective shield for the middle class is a strategy that no longer works. Navigating the modern financial system now requires paying attention to the quiet forces moving underneath the surface. The automated common sense of set it and forget it has been weaponized. To protect your capital, you have to actively understand where the risk is flowing, because right now, that pipeline is pointed directly at you. Let's talk about the bedrock